Google is up 37% year to date. It's one of the 7 companies that makes up the biggest gains of the S&P. Guys, it's at 123, but even though it's up 37% year to date, it's still off its all-time high of 152. It's still about 20% off. And I remember when we did videos in the past, when Google was at 150, and we sat there and said, it's not worth 150, we like it below 100. We literally had comments in the videos of people saying, it'll never go below 100. We're here to talk to you about the opportunities in Google, whether it is an opportunity today or if you should be more patient. We'll get into that. Now remember, guys, if you're new to our channel and you need to learn more, we're going to start out with more basic things. And if you're more advanced and been following our channel for a while, we'll get more advanced as time goes on. For the new people, this is like learning to ride a bike. You just got to get up there and start with turning the wheels, start with the training wheels. That's what we're here to do for you. So please be patient. Now, I'm Paul. Mo here is a value investor as well as a trading expert. We started this channel 2 years ago to teach people 2 things. 1, when you buy a stock, you're buying a piece of a business. And 2, every investment's the present value of all future cash flow. We are here to teach a process. That way you can apply that process on your own, and that gives you more power to decide what to invest in and dictate your financial future. We're not here to just hand out, go buy this. We're here to teach you the process that you can apply to every sort of investment in life. So obviously with Google, it's been in the news a lot as the price goes up and down, and AI is becoming a big factor. ChatGPT, all these things. So Mo, what are the recent news stories on Google that you can point to? Oh, look at this. Introducing a new era of AI-powered ads with Google.
Of course, we have this new surge in price that has come pretty much in the last couple of months, and it's been AI and the Google AI Bard, the chat Bard. So they're going to be competing with ChatGPT. They are going to be incorporating it into their search engines, the search engine that you use on your phone, that little Google app, which is already pretty good. I think about ChatGPT and I think, how can they surpass Google? That's the question that I really have when it comes to the 2 of them fighting each other.
Yeah, but Google has a big leg up in the fact that they already control
93%
of search.
93% of search. I don't know how a Bing, for instance, takes that out with ChatGPT.
I mean, if it becomes that amazing,
yeah,
maybe. I mean, listen, you got to be, whenever you look at any investment, you've got to look at the holes and you've got to decide there's a probability of certain things happening. The question is, what's the probability of ChatGPT overtaking Google and all these things, and Google not at the same time coming up with some sort of response that with their control of I saw the other day that Google has 1.5 billion Gmail users. Wow. There are like 5 billion email addresses in the world. That's 30% or something, or 5 billion people have email addresses. It's like, it's a huge number.
Right.
To take that over and replace it with, I mean, how many people, if I told you right now, Mo, get a new email address, that's so inconvenient.
I have thought about getting a new email address and it's just too difficult. The only solution would be that I forward my new email address to my old one. But the problem is, how many people over the past 15 years have my old email address?
Exactly.
How am I going to get that to them?
Exactly. So you still have the email address of workoutboy69@gmail.com, right?
Correct.
So
email me.
I wonder let's email workoutboy69@gmail.com and see who it is. All right, so what do you have some bull and bear cases on Google?
Okay, so bull cases, I mean, this is a big one, is everybody's going towards streaming, and YouTube TV is a big part of the streaming. They have over 150 million people in the United States using that. Do you use it, or do you use Hulu TV?
No, I use Hulu TV.
Okay, I use YouTube TV. I love it. They're the #1 search engine out there, and they control 93% of the market share for internet search.
How much is it?
I think it's $74.99 right now.
All right, what else you got?
$74.99. So those are your bulls, your bears, and I mean, I could throw this into the bull category too. This AI Bard. So right now they're facing legal issues with the EU and Canada. And
who doesn't face legal issues with the EU?
The thing. I mean, Justice Department has 8 states going after Google as a whole for being monopolistic and stuff. And for me, those are bearish cases, but are they really going to stick?
So it's funny. So we have some experience in doing Google AdWords. Mm-hmm. I determine what words I go after, what phrases I go after, how much I pay for them. So I'm sure there's more to it than that. Don't get me wrong. I'm not this guy who's trying to say, this is ridiculous. What I'm saying, though, is, man, I, as an individual, I'm going to go to the #1 search engine, 93% of market share of internet search.
Yeah.
And then 2, I get to pick the phrases of which I go to. 3, Google will penalize me and they'll reward me if my words and my phrases are more relevant and get a higher click-through rate. And by the way, this is what's incredible about Google. They want to eliminate the middleman. So they sit there and say, listen, if you're selling tennis rackets and you want to use the word sex in there, we're gonna make it cost way more money for you, or it doesn't make sense. That's how they regulate these things. Is it monopolistic? I don't know. I'm sure there's way more to it than what I'm saying.
Yeah.
But I look at this thinking, that's going to be difficult.
Hell of a strategy. That's one thing.
It is a hell of a strategy.
So, all right, let's get on to some of the numbers with Google.
Okay, so guys, going back to what I said earlier, as I talk about certain metrics, I'm going to explain those metrics. And I'm going to explain them in a way that's much simpler, having to do with your personal life. Because personal finances and corporate finances are very similar. I look at a balance sheet the way I'd look at somebody's net worth statement. I look at an income statement the same way I'd look at somebody's, P&L, like budget, expenses, et cetera, on their own personal life. If you think about companies that way, things will start to make a lot more sense. If you're one of the more advanced people who've watched this for a long time, don't worry, we're going to get more in the details, use our stock analyzer tool as time goes on. But first off, Mo, market cap, 1.58 trillion, enterprise value 1.57.
I like that.
I do like that too.
Company.
So this difference is essentially net debt. So there's actually more cash on hand than debt. Market cap is if you bought all the shares of the company at the market price. Enterprise value is all of that plus the debt on the company, because when you buy a company, you have to assume the debt minus the cash. When you see this number be very close to each other, or even enterprise value being lower, that's a good balance sheet. Now, it doesn't say anything about are they burning through cash and ruining that. It doesn't say anything about that. As a snapshot right now, that's what that says. Yep. Okay? 2, PE. Current PE is 27, 5-year PE is 32. Is that expensive?
I don't know.
Exactly.
I mean, actually, it looks halfway decent.
Why does it look halfway decent?
Because I look at saying they have 93% of the market share. This is a moat.
That's a moat. And you should be willing to pay a higher price for a moat.
Yes.
Now, could this be expensive? Absolutely.
It could.
We don't know right now. Because remember, second statement I made, every investment's the present value of all future cash flows. And we'll get to that in the future in this video. But right now, the goal is to say, is this expensive or not? Because if we have a lot of growth potential, look at athletes. When they get drafted, they're given a signing bonus. They're basically being paid something. Is it going to be good? Is it too little? Is it too much? We don't know. The more potential they have, the better that investment is for the team, right?
Yep.
No different. All right. Profit margin, it's actually a little bit down, 20% versus 23.3. But I know Google is one of the first companies to start announcing slashing of employees, and the same thing happened here.
Yep.
There was a lot of pushback on that one.
There was.
Probably a response to this. Now, guys, this gross profit margin, this means for every extra dollar they sell, what percent of that goes basically to the bottom line? If they sold an extra dollar today, 55% of it, 55 cents of that dollar. All right, a couple other things. No dividend yield, not surprising. But the other most important thing I want to talk about is the return on invested capital. Guys, this is what the value investors love. This is what Warren Buffett and all these great investors love. A company you can take on 2 ways in order to start a company. Take on debt or take on investors or put your own money in as an investor. Those are the 2 methods. That is the capital within the business. This return is based on the net income of those 2 things combined. So you add those 2 things up. If it's $10 of equity and $10 of debt, that's $20 total invested in the business. Now, why do these matter? Well, this basically says we can get a good return on our money. And this also talks about moat. And the more money we invest and get these returns, they can drive this profit up. Right? We should want to pay more money for a company with a higher return on invested capital. And later on in our stock analyzer tool, we actually show the 1, 5, and 10-year return on invested capital. Is it getting better? Is it getting worse? One thing that's interesting, Mo, is even though the profit margin's down, the return on invested capital is actually up.
Interesting.
Yeah. That's something very interesting. Why is that? We don't know yet.
Yeah.
Now we're going to go into the 8 pillars.
Yeah, let's look at them.
So Mo, why don't you talk through some of the 8 pillars here?
So These 8 pillars are something that we like to see. So remember, guys, the 8 pillars, if everything's green, it doesn't mean instantly go buy. If everything's red, it doesn't mean that it's terrible. Like Paul has said in previous videos, there's been pillars that have been all red and we bought, and all green and we say, no way in hell we'd touch these. But right here, we just have our valuation metrics off. You saw that 5-year PE and 5-year price to free cash flow that are greater than 22.5. Is that a bad thing? Is that a good thing? Like we said earlier, we don't know. But this is a starting point in a screening process that you can use to go through and pick stocks that you want to go deeper on.
So let's talk about that to make sure people aren't confused. Even though these are red, if I told you right now that Google is going to double its profit and cash flow every year for the next 20 years,
I'm buying.
I'd pay 5 times this.
I do not care what that is, yeah.
I don't care. I mean, like, that's insane.
Yes.
If I told you it was going to decline for the next 5 years, you'd be like, wait a second, is this too much?
Yes.
So the exact same metric can be good or bad depending on what the future looks like.
Right.
That's the big thing. Now, the key is in investing, usually when this number is higher, people are overpricing the benefits of the future. And when this number is lower, they're discounting too much. They're putting too much negativity into it. And that's our goal, to look at it from that perspective. But one thing I want to show you guys that I love, look at this debt. This is our debt metric.
Wow.
This says that if they basically can pay off their debt with about 10 months of their last 5 years free cash flow.
So incredible.
10 months, and they could have no debt in the company. That had to do with our enterprise value to market cap. That's the impressive part. Everything else, wonderful.
Yep.
Now, they're buying back shares.
Yeah, can't say we love that.
We like them buying back shares as long as they're very cheap shares. There's no indication these are obviously cheap shares. They could be cheap, but there's no indication they actually are. All right? So guys, this is our software. We made this specifically for our users. It has all these tools. You can even customize your 8 pillars up to 12 pillars. It also includes the community here, thousands of investors you can go in there and talk to about your investment ideas on a daily, hourly basis. Thousands of active people messaging every single day. You can try it out, everythingmoney.com, $7 for 7 days. That's $1 per day. That's it. This will absolutely change the way you look at investing. You haven't even seen our stock analyzer tool yet. This is the most important part. It allows you to make assumptions about the future, and based on those assumptions, it'll tell you what price do you need to pay today in order to justify those assumptions.
Yeah.
And that alone will save you potentially tens of thousands or $100,000 in your lifetime easily.
Yep.
So let's check out what the analysts are saying about our good friend Google.
Now, guys, remember, take analysts with a grain of salt. I've said it before. There was no analyst out there that said Silicon Valley Bank was in trouble. They actually, tons of them had buy ratings.
Yes.
Nobody had a sell rating. So take it with a grain of salt, but
By the way,
use them as a guide.
The week before, nobody
before,
had it.
Exactly.
There wasn't a single sell rating the week before.
So remember that when you guys are looking at analyst estimates.
But it's a nice place to start, and
Little
that's why we
guide.
put it on our site. Mo and I still look at it, because sometimes we'll go, man, how did they get such a high number? Or, wow, are they actually being too low here?
They're not factoring something into it. Who knows?
Because remember, they have career risk.
Yeah.
So their goal is to be as close to each other as possible. Look at this growth here, Mo. It's pretty good.
That's pretty good growth.
Apart from this next year,
Yep.
they're estimating mid
Mid-teens.
high single digit, double digit growth in EPS. Revenue, high single digit, low double digits. And guys, earnings per share will grow faster as revenue grows because of that gross margin being 55%, and also as they buy back more shares. So remember, when they buy back shares, they're now splitting that revenue and profit amongst less shares. That'll make the earnings per share go up, right? So as earnings per, if you had, this is gonna be a morbid example, but let's say this. Let's say you have a nice estate. You have $1 million estate, and you have 5 heirs. You have 2 nephews and 3 kids, and you're splitting it evenly. That's 5 ways. All of a sudden, one of the nephews hates you. They mother F you, and you say, they're out. You get rid of them. Now you're splitting that $1 million amongst 4 people, $250,000 each. No different here.
You have less shares, pie gets bigger for whoever's involved.
Correct. So if you just buy the company and stick along with it, and they keep buying back shares, they're rewarding you as an investor. But remember, that cash they're using is your cash because you own part of the business. So you want to make sure they're buying back cheap shares, not expensive ones. Remember that. Even though everybody will sit there till they're blue in the face and buy back expensive shares, it's not good if they're buying back expensive shares. It's no different than buying another company at an expensive price.
Yep.
All right? So those are the things so far. Guys, you've stuck with us. We're going to do the stock analyzer tool now. This one is Guys, I love this tool. Mo and I use this every single day, several times a day. Dalton, who's our analyst, our researcher, he uses all the time, sends screenshots. How many times am I in the community and I see people saying, hey, these are my assumptions about this company. What does everybody think? There's a lot of engagement for that. So we're going to do a 10-year analysis. Now, Mo, look at this. Remember I talked about that?
Increasing
ROIC.
Yep.
Now, this is only 1 year of it.
Right.
But I like seeing that.
Right.
That, to me, tells me the moat's getting better and better, and they're getting better about having opportunities to invest at higher rates of return if they want to.
Right.
So I should be willing to pay a premium for the company. Let's take some assumptions for the next 10 years on our revenue growth. Mo?
Okay. What do you think about 3, 6, and 9?
I think that's very low, but here's why, Mo.
Why do you want to go 3?
I want to go 4,
Oh,
8, and 12.
interesting. Okay.
And here's why, Mo.
Tell me.
Do you see a world in which AI doesn't benefit them even if they aren't the number one because of their search?
No.
So
They're
I look
gonna
at
be
this going,
benefited.
10-year growth of 8% a year. That's over doubling. Is that really unrealistic? The revenue over doubling in the next 10 years?
My only thing would be, what if AI doesn't work out the way that everybody's thinking? Like maybe the metaverse. Look at the metaverse.
Okay, how about this? How about 4, 7, and 10?
Okay. All right.
So guys, this is part of the conversation that we have internally. These are the reasons why the community is so beneficial, because we will have people talking every single day about, hey, is my assumption reasonable here? I'll get people all the time, and I'll say sometimes like, whoa, this assumption is ridiculous on the high side. And there's other people I'm like, why are you factoring in 2%? I just want to be conservative. Okay, but I think they're going to do 8%. Guys, as the world becomes bigger and bigger and attaches to computers more and more, Google's going to benefit. Google's going to benefit. And that's why I think 7% is a reasonable number. That's doubling their revenue in 10 years by the rule of 72.
Yeah.
All right, profit margin, Mo.
I was going to say start at 18, but I think that might be a little bit low.
I think that's low.
Maybe 19 is a low.
I think 20.
20, 23, 26.
Okay. So why'd you go with 26 on the high side? Because I agree with you on that one, but explain that.
I think that if this AI stuff works out, and Google, a lot of it is advertising. I think that they can increase their margins over time. And as they increase their profit margins, overall profit margin is going to improve.
Because I wonder how much overhead they have to take on.
That's it. How much can there be? It's almost like the drug world. Once you get a drug out there, you just
Talking
roll
about,
with it.
what kind of drug are we talking about here?
Cocaine.
Yeah, okay.
Pharmaceuticals.
So what about free cash flow margin? We can do the same thing?
Yeah, same thing.
And guys, look at this. One question we always get, and for our more advanced people, what assumptions, how do I make these assumptions? Well, we look at history, we look at our future, we put them together, and we kind of put a range in there. I think to myself, like, would I be absolutely floored if they got 20%? No, I'd be shocked, but I wouldn't be floored. I'd be surprised. 26%, I'd be pleasantly surprised. So I'm making a really high estimation here, but I encourage that. I encourage you to make high estimations because I want you to also sit there and if these high estimations end up with still an overpriced company, you know how overpriced it really is. All right, Mo, PE and price to free cash flow multiple.
I said 17, 20, and 23.
I actually don't disagree. Now, guys, here's the thing. The average in the market's 15 or 16, but this is Google, and it's got a high, you should pay, if the market average of ROIC is 9 to 10%, you should pay a premium for a higher and sustaining and even growing return on invested capital.
Yeah.
This is a company that's expanding its moat.
Yeah.
And as they invest more and more into the business, they're getting higher and higher returns.
Right.
That means they can drive up that profit margin at a much higher rate. So that's why you put a higher multiple in. This is all part of the learning process. You will get much, much better at this as time goes on. Even the people watching right now who've watched 150 of our videos, you've probably gotten this now going, yeah, this makes sense. Mo, what are you doing for desired annual return?
I did 10, 12, and 14%. What do you think?
I think that's reasonable.
Cool.
And the reason being, so guys, as your assumptions go bigger and bigger, you need to have higher return because it gives you a higher margin of safety, right? The higher your margin of safety, the better it is. Now, this is a pretty low, there's actually no margin of safety here.
No. But I think 4% and 20% margins, I think they can do that all day.
Yeah,
They can
I
do
think
that
these are
on
very
accident.
low assumptions.
Yeah, stay the way they are. They
Like,
can do that.
guys, if you put 0 in here, if you put 0, 15, all the way, I'd be like, okay, I need a 6% return because that's pretty low. So that's the whole part of the community, talking about it there and understanding that whole aspect of how you put these assumptions in. All right? The current price is $124. Now, before you guys go, We're going to show the numbers, but I want to show you also, these are with our margin of safety already in here. That doesn't mean what we think the company is worth. This is essentially what we think the company is worth if they hit these numbers. But the other two are with margin of safety. It should be a lower price than what we think the company is worth. We hit the analyze button. Boom. A low price of 76, a high of 140, and a middle price of 105. So guys, look at this. If you believe all these high assumptions,
Yep.
you should buy our stock right now.
Yep.
Or at least go do more research. If you believe the middle assumptions, you gotta wait a little bit. But the good news is it was at $83 just a few months ago.
Yep.
If you believe the low assumptions, you gotta wait quite a bit. All right. So guys, everythingmoney.com. Check it out. $1 a day for 7 days on our software. Worst case, subscribe to our channel, learn some more. It will change the way you view money because the more you learn, the less you fear. Thank you very much for your time.